China has become the world's largest miner of industrial metals and its largest consumer. Pollution levels in the world's most inhabited country have reached such high degrees that mortality and health-related issues are costing the government more than the benefit it gains from mining raw materials. China is putting a gridlock on miners. Regulations, restrictions, and strict requirements are causing smelters to shut down, so the supply of zinc, copper, and iron ore is depleting fast. Mining-friendly governments can't keep up with the demand though. Zinc has 1 week of stockpiles left on the London Metals Exchange. The spot price is up 90% in 2 years, but still no major discoveries have been made. In fact, mines have been closing due to depletion. We're in the last innings of a 9-year business cycle, and commodities demand soars as the three major economies, the US, China, and Europe, along with emerging markets, are all growing together. Zinc miners have not joined the bull market party yet, but I'm personally getting extremely interested in one Canadian play right now because of its potential to be taken over, according to its chairman of the advisory board, for 5 to 7 times the current market cap in 2 to 3 years' time. That's a massive upside potential. Go to wealthresearchgroup.com/merger, MERGER, to learn about the #1 potential takeover target stock in the entire resource sector. That's wealthresearchgroup.com/merger. Welcome to the Titans of Industry show. We've got a killer interview for you today because our guest was an employee of the Federal Reserve for 9 years and since has left and wrote a seminal book about the truth regarding the modern day Fed, which is quite different than the original idea 105 years ago, according to her. I'm of course speaking with Danielle DiMartino Booth, who wrote the bestseller Fed Up, and we'll have another bombshell interview with Danielle the day of the release of the May Fed Commission's market, which will be epic, live from New York. Danielle, how are you today?
I'm doing great. How are you?
I'm doing very well myself. Your focus has always been central banks, specifically the Fed. Let's discuss how the Fed sees their role and their performance in a tightening period. First of all, what is the Fed funds rate and why is it important?
Well, the Fed funds rate is technically the rate at which financial institutions lend to one another on an overnight basis. But on a broader level, if you will, if you step back, the Fed funds rate is kind of the anchor, the low end of the yield curve, the shortest term maturity that investors gauge, as opposed to the longest term maturity, which would be a 30-year rate. It's the short end of the curve, if you will, the yield curve that the Federal Reserve technically controls through its interest rate policies.
What is the use that investors make with the Fed funds rate in terms of comparison with Treasury yields?
Well, investors do compare it to a Treasury yield. The 2-year Treasury is the one that tracks it the most closely. In a world that, as you know, has gone very global, they also might compare it to a German Bund rate or a British sterling rate to see where borrowing costs are in the United States vis-a-vis other countries. And from an economic perspective, you also view where the Federal Reserve sees the Fed funds rate as being, as what their interpretation of the economy is at any given point in time. If they're hiking interest rates, and they've been in a hiking phase, a very slow hiking pace since December 2015, then they view the economy as being capable of handling higher borrowing costs. So they view inflation as rising, and they view the economy as strengthening.
What is the correlation between the Fed funds rate and the Treasury yield on the 2, 5, and 10-year bond, and how do they relate to gold prices and stock market performance? In other words, historical data shows that when the Fed funds rate is higher than the 5-year bond, the market tends to peak, and some months later, the economy rolls over into recession. Are they aware of these cycles, and are they conscious of how predictable they are?
It is absolutely predictable, and you know, there are reasons for us to be a little bit more heartened going forward about the Federal Reserve's awareness, if you will, about the yield curve, which is what you're talking about. Jay Powell, his background is primarily in finance, and the most recently released minutes from the Federal Open Market Committee meeting that took place showed that there was discussion around the table about the closeness of short-term and longer-term maturities. So there's a higher awareness, if you will, of the yield curve, and I'm very, very heartened by that. If you look back to 2007 and congressional testimony that then Chairman Ben Bernanke gave, he basically said, well, we do pay attention to the differential between shorter and longer term rates, but we don't feel that they're necessarily predictive of recessions. I don't think that incoming Fed Chair Jay Powell is that naive.
Lower taxes are obviously better than higher taxes if you want a free market economy. What do you see as the impact in terms of investor behavior and CEOs' behavior giving these cuts?
Well, clearly we've seen an unleashing of animal spirits in the C-suites of this country. I mean, we're at upwards of 150 companies right now, at least. And that's just the ones that we know about through the headlines, to say nothing of what small businesses might do going forward. But what we know right now is that many companies have seen fit to give either one-time bonuses or something a little bit more long-lasting in terms of what Visa did recently, and they increased the matching that they're doing on their 401ks. But companies are clearly seeing the economic benefit of the tax plan. The question is whether or not it is lasting and ends up being a long-term benefit, or whether or not it's just a shot in the arm to the economy in 2018. We will have to wait and see.
America's heartland belt is starting to boom again. Texas, Oklahoma, Michigan, Wyoming, North Dakota, Utah, Colorado. These states now post the highest GDP growth of all the 52 states. Since the recession, we've not seen America's inner states leading the outer ring: New York, Florida, and California. And so, with China becoming a more developed economy with a thriving middle class, is America's infrastructure and manufacturing base getting competitive and beginning to improve? There are many positive numbers coming out, or do you see this as something fleeting because of the natural disasters that America endured during 2017?
Well, you're talking about two separate but decidedly related subjects here. Clearly, the rise of the middle class in China reflects the cost differential getting worse as a factor of time, because their salaries, the prices that they pay their workers has increased. And so that has made it less cost beneficial for all manufacturing to occur in Asia. So you're speaking to one separate subject that clearly is reflected. The mirror image of that is the rise of the middle class in China. But that also makes it a lot more cost effective to do manufacturing closer to home. I don't want to get too ahead of the discussion, however, because you have to bear in mind that we've just come through quite the historic year when it comes to natural disasters. And we've had the dollar at a three-year low in terms of being weak. And on top of that, we've had oil prices rising. So there are many different contributing factors to the reason that, as you point out rightly, if you were to draw a line down the middle of the country, manufacturing has clearly improved. But what I want to see is the second half of 2018 continue in terms of strength after all the rebuilding efforts have come and gone.
You're at a point where you want to see whether or not these growth spurts caused by the aftermath of natural disasters are the reason for ticked up economic activity, or whether a more permanent factor is at play. Danielle, household savings rate is at an all-time low, 3% right now. They can't go any lower. In other words, for the U.S. service-based economy to tick up, tax cuts were needed in order to generate disposable income. But will these be enough now that 80 million Americans are retiring and many live off of government subsidies? Will this cause much more deficit spending and less foreign buyers in the Treasury auctions?
Well, that works until it doesn't work. And but the most important thing to consider is, historically speaking, the country that rules the seas retains reserve currency status. And that is a very militaristic way of looking at it, but that has held true since Portugal had the reserve currency status, and then Spain, and then the United Kingdom. I might have gotten Portugal and Spain mixed up there. So, but again, it has to do with he who rules the seas, the country that rules the seas, and the U.S. Navy still predominates. But it is a very slippery slope, given the entitlement spending that you speak to rely on that indefinitely and say that the United States does not have to put its fiscal house in order as baby boomers begin to retire in earnest and our off-balance sheet liabilities begin to become cash flow issues for the country. So there could be an increase in interest rates, and we have seen China back off. We have seen Japan back away from our Treasury auctions, and certainly shorten the maturities of Treasuries that they're willing to hold. So there are definitely red flags out in the distance that are telling the United States government that they should become more fiscally prudent going forward and look to ways that they can come to a lower debt level overall, or we're going to risk that reserve currency status over the long haul.
Danielle, you worked for the Fed, right?
Yeah, many years throughout the crisis, almost 9 years as an advisor at the Federal Reserve, yes.
Does the Fed know the amount of negative sentiment towards it online?
You know, it's interesting. I wrote about that this last week in my newsletter. If anything is ever mentioned on my Twitter feed that is even remotely in defense of the Fed, the hatred, the vitriol, the backlash, I mean, it's as if there are people out there carrying pitchforks because the anger level with the Federal Reserve is so high right now. And I don't know that all of the pure academics at the Fed can wrap their heads around why there is so much anger that is finally being directed at the central bank after many generations. We're talking about multiple generations since Alan Greenspan took office in August 1987. This recognition that central banks of the world have become the bad guys by forcing interest rates to the zero bound, or even worse in Europe and in Japan into negative territory, and thereby punishing savers and forcing investors to invest in the stock market even when it's not appropriate for their age. I think that this recognition is something that is fairly new to central bankers, but they have to be aware. You would think that they would have to be aware of the public anger and the increasing public anger against Federal Reserve and other central banking officials.
I'll take us to the next question, Danielle. But before I do, it's important that I note that from what I've seen over the years, over the past decade, the resentment towards the Fed goes much deeper than frustration caused by bailing out big banks and lowering interest rates to zero. There's a grand sense of a giant conspiracy, a sort of a criminal organization called the Shadow State or the Deep State, working towards their own agenda through the means of the banking system without getting elected and without changing the guard for centuries. Going back to the inception of the Fed on Jekyll Island Club, the core hatred comes from the sound money crowd, who are furious for the fact that the U.S. doesn't practice a gold standard and doesn't practice any fiscal restraint, and are letting the purchasing power of the dollar go down by 90+% in 1 century. Do you think that leaving the gold standard was a detrimental mistake back in 1971?
Well, you ask a very nuanced question. And I think that the insistence of staying on the gold standard is what actually brought British pound sterling to its knees and caused Great Britain to lose the reserve currency status. And I will tell you that I am not very popular with the conspiracy theorists because of the time that I spent inside the Fed. It took me away from Jekyll Island in 1913 and corrupt bankers trying to rule the world and the gold standard and the need to go back to it. I am diametrically on the opposite end of the spectrum to that, because what the Federal Reserve and what other central banks have evolved into being is actually a very genteel group of individuals who are actually far removed from the banking system, too far removed from the banking system to properly understand, much less regulated. Central banks have become a group of academics, of PhDs, who have decided that they understand how the world financial system should work, even though they've learned it only out of a textbook. So I push back against the people who go back to the creature from Jekyll Island and try and emphasize that had the central bankers of the world had a better understanding of the banks that they were supposedly regulating in 2008 and 2009, that we wouldn't have gotten into the financial crisis that we did to begin with. I think the Fed has marched too far off the reservation, and that it's time to bring bankers back inside of the Federal Reserve. So I have a much different philosophy, mainly because I worked inside the Fed, about the role that it has played in our banking system.
Let's talk about the wealth gap in America. In real terms, the stock market returned enormous gains to contrarian investors who were liquid after the crash and bought high-quality businesses in 2009, 2010, and 2011. I know I bought some of the most stable businesses, and they've all doubled, tripled, quadrupled. Some of them have even gone up 600%, like 3M, a giant industrial company. But most families do not live from investment returns. For most family, their net worth is tied to their main property, their single family home. This rally for stocks and for real estate, which I was heavily buying from bank foreclosures up until 2013, are not there anymore. In other words, the market is very expensive, both in real estate and in the stock market. Meanwhile, Main Street didn't participate in the boom, and their wages did not rise meaningfully, if at all. And worst of all, they're now just getting into real estate and the stock market when the valuations are so high. Has there ever been a more economically and socially divided America? And what does that mean about the country's wherewithal to weather through a 6 to 12 months recession, which is bound to occur soon?
Well, if it's every 6-7 years, we're well past our expiration date at this juncture. But to answer your question, no, the country has never been as divided as it is. Well, that's not true. The company has been as divided as it is in the years that began with the stock market crash of 1929, and in the years prior to the Civil War, we've been as divided as we are today. But since the Great Depression, no, inequality has not been as acute as it is. I don't think that the Federal Reserve is aware of the role that they've played in this, or that they've necessarily accepted responsibility. But you have to bear in mind, in the years that led up to the financial crisis, at least lower income Americans felt that they were participating in the financial boom, wrongly so, mind you, because they had access to subprime mortgages. But at least there was a feeling of participation in the economic recovery and in the fruits of low interest rates, opening up mortgage lending standards to where people who prior to 05 and 06 could not qualify for these mortgages. But the opposite has been the case since 2009. It's been prohibitively difficult for people of lower incomes to be able to buy into homes. The Fed policy has actually exacerbated the situation in a zero interest rate environment. If you're an apartment developer, the only thing that you're interested in building is high-end apartments, and private equity was invited into the single-family home sector. So they bought up a lot of vacant homes, and they're now more expensive to rent than they have ever been. So that, and as you rightly point out, many Americans, about half of Americans, don't have any exposure to the stock market, so they have not enjoyed the fruits of the Fed's low interest rate policy. So all of these factors, the fact that housing is more expensive, renting is more expensive than it's ever been, and that the Fed's low interest rate policy has benefited the top 1% to such an extent, all of these things have increased the inequality divide and made it that much more difficult on a socioeconomic level for the country to withstand what's to come when we do hit the next recession. Your observation is very cogent.
In terms of commodities, it looks like oil is heading higher, zinc is up 90% in 2 years, gold is up big, and silver is trading higher. Should mining shares investors be ready for a nice cycle here? The merger and acquisitions activity is picking up, exploration budgets are up, but discoveries are at centrally low success rates. So we've got a real supply shortage right now in many of the key commodities, especially with China ramping up regulations.
Definitely on a valuation basis, relatively speaking, the commodities complex is much more of a value play than it has been in a long time. The only word of caution that I would put out there is that Chinese policymakers may have unwittingly pushed the price of a lot of these metals up higher than they should be in trying to help downsize some of the less efficient operators in the steel space, users of iron ore and what have you, and copper. So I think that there will be cross currents in the year to come in the metals complex, and that people should tread very lightly, given the fact that there has been a recent run up to very high levels across the commodities complex.
Danielle, I want to ask you a two-part question. A, what is the view of central banks towards gold? B, do you believe that commercial banks are out there suppressing the precious metals prices?
Well, I think that there was a lot of nefarious warehousing of metals by the banks. This is a kind of a pre-Dodd-Frank proprietary trading world, and I don't necessarily buy into anymore that there is manipulation in this space. But to answer your question about the Federal Reserve and how they view gold, gold is a subject that deeply divides central bankers. They very much hold on to very tightly the idea of the fiat currency being the standard. And so they look to the gold bugs, if you will, as being their enemy of sorts, because they have moved onto a paper currency platform, and by golly, they're going to defend that to the death. So I think that there is, I think there's a lack of appreciation of what the price of gold reflects about central banking, and that there should be more of a discussion of gold incorporated into policymaking going forward. Again, my philosophy does not align with that of many, but then I also worked for Richard Fisher, who was one of the biggest hawks on the Federal Open Market Committee when he was president of the Dallas Federal Reserve, and he did pay attention to gold prices, and I do pay attention to gold prices, especially as how they reflect people's confidence, but more importantly, people's lack of confidence in the dollar as a store of value.
What is the view of the Fed about the severity of the national debt?
Well, I think that there's definitely, especially in the past few years, as we've cruised right past 20 trillion and kept going, I think that there is definitely alarm inside the Federal Reserve at the growing debt levels, and there's been a public recognition that we can't keep going at the same trajectory. But I draw the line at central bankers being openly distressed about debt levels, because debt levels worldwide wouldn't be pushing $350 trillion had it not been for the over-exuberant efforts of central bankers keeping interest rates as low as they have been. Because in my personal opinion, this is one of the gravest sins of central bankers, is that they have been the facilitators. They have been the enablers. They have been the bankers of governments, households, corporations worldwide in tacking on these record debt levels. And I say to them, and I'm very public about this, shame on you, because this is going to be a drag on my children's and my grandchildren's generations for years to come, because you could not manage to say no to governments and instead kept interest rates at artificially low levels to facilitate and enable the stockpiling of these massive debt levels that will be a drag on growth for generations to come.
Danielle, any parting thoughts, things that are important for people to watch in 2018?
I think that what investors, what borrowers should be paying very close attention to is the real changing of the guard at the Federal Reserve. Jay Powell is the first non-PhD. He's the first non-academic, the first individual who's not been a professor at the front of a classroom to run the Federal Reserve in over 30 years since Paul Volcker was at the helm of the Fed. He's proven time and again that he's aware of the financial markets and the role that they play, but he's not been beholden to them. This is also an individual who worked for a salary of $1 to educate the Congress on the dangers of the U.S. defaulting on its debt. So he is by far the most objective, independent, and diverse, intellectually diverse individual in well over 30 years to head the Fed. And the current administration has been very, very open about appointing other members to fill vacancies at the Federal Reserve board level that are not necessarily pure academics. So, it was interesting. You might Google it, that Mario Draghi himself stepped down from a group called the Group of 30 in the past few days. And that is almost a purely academic group of global central bankers. I think there's a growing recognition that it cannot be pure academics running the central banks of the world, but rather individuals who understand all of the entities on the receiving end of central banking policies that have to be incorporated into monetary policy making going forward. So don't lose hope necessarily in the central banks of the world, because their failures of the past 30 years may finally be recognized on a world stage. And it's about time that we had a regime change in the way monetary policy is made here in the United States and outside of our borders as well.
Please tell us about your book, Fed Up, and where can people get it?
So I recorded the book myself, so you can certainly download it on Audible, or you can hop on Amazon or go to Barnes and Noble and get the book. The genesis of the book was my deep internal disgust, disgust with the Federal Reserve, because they had a chance to reinvent themselves in the aftermath of the financial crisis and squandered it. I think that that's an outgrowth of the terrible hubris that has infected the institution for years. And so I decided to write the first seminal book on the Federal Reserve since The Creature from Jekyll Island as an insider that exposed the institution for what it is. And as a result, it has been very, very popular. It went up to number 22 on Amazon. And I also write a weekly newsletter, which you can get at my website, DiMartinoBooth.com, or follow me on Twitter at DiMartinoBooth, where I continue to write about these issues on a weekly basis.
Before leaving us, every American would like to know, is the US dollar in danger of losing its reserve status, in your opinion?
Well, my short answer is that there's probably a $3.1 trillion runway in between that happening, in that we have to follow the level of Chinese reserves. And when that has been depleted, then you run the risk globally of a currency war becoming a hot war, an actual war. But for the time being, for the medium term, I would say that answer is no. We still retain the power. As long as they continue to need us, as we continue to need them, then the balance will be retained. If the Chinese can manage to move more transactions onto the yuan as a platform, they will succeed. But what most people don't realize is that since China joined the SDR, the level of yuan transactions globally has actually decreased. So they have a long road in front of them before they can displace the US dollar.
Danielle, thanks for being here. I really appreciate it, and this was a very insightful interview.
Look forward to talking to you again. Thank you very much for your time.
China has become the world's largest miner of industrial metals and its largest consumer. Pollution levels in the world's most inhabited country have reached such high degrees that mortality and health-related issues are costing the government more than the benefited gains from mining raw materials. China is putting a gridlock on miners. Regulations, restrictions, and strict requirements are causing smelters to shut down, so the supply of zinc, copper, and iron ore is depleting fast. Mining-friendly governments can't keep up with the demand though. Zinc has 1 week of stockpiles left on the London Metals Exchange. The spot price is up 90% in 2 years, but still no major discoveries have been made. In fact, mines have been closing due to depletion. We're in the last innings of a 9-year business cycle, and commodities demand soars as the 3 major economies, the US, China, and Europe, along with emerging markets, are all growing together. Zinc miners have not joined the bull market party yet, but I'm personally getting extremely interested in one Canadian play right now because of its potential to be taken over, according to its chairman of the advisory board, for 5 to 7 times the current market cap in 2 to 3 years' time. That's a massive upside potential. Go to wealthresearchgroup.com/merger, MERGER, to learn about the #1 potential takeover target stock in the entire resource sector. That's wealthresearchgroup.com/merger.